Trading, for many, just gambling. For others, unknown science. For a few, specific probability fields that we can leverage in order to extract wealth. Today we are fending off the noise and understanding the mathematics and the core concepts that are fundamental for basic trading understanding. Hello fellow wealth seekers! Today we go a little more educational. I'm gonna try to explain in a simple and relatable way basic trading concepts. Not that it's rocket science, so that we demystify the misunderstandings around this, and perhaps, if not trading, but at least reading a graph becomes a bit more familiar for all of you. We start with candlesticks. These are millions of transactions condensed within one day. The size of a candlestick indicates the amount of transactions that happened over that day, be it towards the upper side or towards the lower side. Each day will represent one candlestick that then will develop gradiently up or down. The body of a candlestick is basically informing the cardinality of transactions, how many were executed in a given day. Then we speak about lower shadow and upper shadow. Basically, these limits indicate support and rejection. If the shadow of a candlestick is particularly long but not thick towards the upper side, it indicates that the price has tried to go up, trades have tried to upprice the stock, but the market has forced lower capitalization. Basically, there's a rejection towards higher prices, but it shows momentum. Lower shadows indicate support. If we see thinning candle shadows going towards the lower side, it indicates that below a certain point, the market rejects declining further. Support, in this specific case, means that is the bottom price of a given stock for that given day. The market does not accept going lower than that. Now let's talk about patterns. There's two key ones I would like to explain. Number one is the doji. The doji indicates a balance between bears and bulls. Bears are detractors of a specific stock, a ticker, and bulls are promoters that want the price to increase. Basically, doji is full balance and the body is balanced with lower shadow at the bottom and at the top, not necessarily thinning and well distributed. A bearish pin is instead when the upper shadow is strongly demarcated, particularly long and thin, meaning that bulls tried to increase the price, but bears forcefully and clearly forced the price down and stalled the momentum. One specific bearish pin is not necessarily a trend line in an ascending momentum, but a few days in a row with this specific trend indicate a potential probabilistic reversal, meaning that the price might have reached its top position for this specific moment and there is no further appreciation potential. And now the most important bit, trend lines. We connect candlesticks with patterns with broader trend lines. This is extremely important because the market has some sort of logical memory. You will be able to draw a line between the floor and the ceiling where the prices have been interacting most frequently. This is a mere question of how many times the price has floated around a certain resistance level or a certain support level. The important thing is once support gets broken, this becomes resistance. And once resistance is broken, this becomes support, meaning the new line determines the older line as a flooring. What was the ceiling now becomes the floor. And there you see ascending or descending patterns. Exactly in these pivotal points you deploy capital. Not when the price is floating in space, but when it geometrically interacts with these new support and resistance lines. I want to take a real-world, highly volatile asset, such as Bitcoin. Let's backtest looking at daily interactions, and you can use a tool such as TradingView, which is free for everybody to use. So here we are. Let's identify a clear support trend line. After an indecision, doji, or a couple of days of indecision, we decide that the support line will close exactly at the moment of a bullish pin bar, a rejection of lower prices. So that becomes our new support. We don't go below this. The next day, we decide to place an order. Let's say it's at 65,000 euros. We place a sell order that is called a stop loss for 2% below that, meaning we reject all losses below 2%, that's our bottom line. And a take profit order, meaning a sell, for 3 times as much that. So our risk to reward ratio is 1 to 3. The moment the price reaches 6% above our buying price is when this automatic selling order will trigger. Now, BTC, there's an uptrend when you look at the first interaction, but it pulls back aggressively at the moment the support line becomes too steep. You will see a massive bullish pin bar forming, the lower shadow pierces the support, but the daily body still manages to close above that. The market clearly rejected this drop. We enter the next day open. Stop loss is set 2% as we mentioned. Institutional capital steps in. The price aggressively ascends over the next 12 days, hitting our resistance target, and we get plus 3R, which means 1 to 3 risk to reward ratio, and we have successfully sold at 6% above our order price. This is case number 1. Obviously, we feel good and we continue to interact a bit. Let's go for a few weeks later when BTC drops back to the support line that we already defined. A doji forms perfectly on that line. Momentum is obviously stalling. We enter at the next open, as we discussed. We enter after a doji or a couple of days of doji. The stop loss is still 2% below our order. The macroeconomic data shifts overnight because there is an unexpected inflation data and the market panics. So this time our strategy was correct, but simply got overturned by broader market dimensions, and in this case, panic. The next day candle is massive, solid and red, meaning it crashes through our support line, and the stop loss is triggered automatically. You don't move it. This is to make sure you prevent further losses whenever there's a panic. In this case, you cut a loss. That's about that. Now, as we are defensive investors, I want to show you another case of a loss that does not depend on broader structural factors. BTC establishes a new support floor after the crash, a bullish pin bar is formed, we enter, the stop loss is set, the price chops a bit sideways for 4 days, it is obviously still undecided, it does not uptick as quickly as the first case we went through. If the price pushes slightly up, it violently kicks down, meaning our stop loss is slightly triggered. There's a fraction of a percent that causes our stop loss. But after that, it immediately reverses and shoots up our target. You were right about the direction. If not for the stop loss, you would have made a profit, but the market noise stopped you out. That is the psychological breaking point for most traders. This is the point in which everybody thinks, oh, what if, what could have happened? But in hindsight, the machine-based statistical trader cannot draw any justification. A loss is a loss, we must accept the stop loss. You see, total trades executed 3, winning trades 1, the win rate was only 33%. If you look at this with a gambler's mindset, you feel like a failure. You were wrong more often than when you were right. You suffered consecutive losses, inducing a psychological shakeout. But look at the ledger. Since you establish a 3-to-1 clear risk-to-reward ratio, the one win offsets the 2 losses because it came at a higher margin. You, let's say, risked 1,000 per trade. The first one brought you back 3,000. The other 2 actually cost you, but you're still plus 1K in total balance. So it is not a gambling game. It is a matter of setting rules, absorbing the market, and clinically, coldly watching the statistics unfold, not predicting the future. Backtesting with a machine-based algorithm and not with human psychological terror or optimism or risk. And this is why most people don't want to touch this topic. They don't want to dip their toes because it feels random, it feels aleatory, while actually it is the probabilistic aspect of machine interaction and not simply our human behavior. Capital extraction must happen where the asymmetric risk is worthy, according to candlesticks, patterns, and trend lines. I hope this was helpful. Leave a like and subscribe if so, and let me know if a bit more advanced content such as this one is helpful. I will see you at the next session. European Wealth Lab out.